Oil markets are repricing risk. Brent crude has moved sharply higher in recent sessions, and analysts are openly discussing the $90 to $100 range as a plausible near-term level. But this is not merely a commodity story, it is a transmission story. And when energy markets reprice risk, the global financial system adjusts. When oil rises due to geopolitical supply concerns, the effect does not remain confined to the pump. It moves through producer costs, through inflation expectations, through central bank policy, through bond markets, through fiscal balances, through global leverage structures. In a system already operating with elevated debt loads, energy volatility is rarely isolated. It is the first domino. Approximately 1/5 of the world's seaborne oil passes through the Strait of Hormuz. It is one of the most strategically exposed energy choke points in the global system. Even the perception of elevated risk, naval positioning, insurance repricing, shipping delays, introduces a premium into forward oil contracts. Markets do not require actual physical shortages to adjust. They price probability. When that probability increases, futures markets move immediately. This is classic risk repricing. And risk repricing is where macro consequences begin. Oil is embedded across the production system, transportation, chemicals, fertilizers, logistics, manufacturing inputs. When crude rises, marginal costs rise almost everywhere. Those costs eventually pass through to final prices. Energy has both direct and indirect weight within consumer price indices. A sustained move toward $100 Brent can meaningfully lift headline inflation. But the deeper shift occurs in expectations. When inflation expectations move upward, monetary policy frameworks must respond. Rate paths that were softening can flatten. Policy that was restrictive can remain so longer. And this is where energy begins interacting directly with debt dynamics. Higher oil can mean higher inflation. Higher inflation can mean sustained or higher interest rates. Higher rates increase the cost of servicing existing debt. For governments running structural deficits, fiscal space narrows. For corporations refinancing bonds, rollover costs rise. The global system is already operating with historically elevated sovereign and corporate leverage. In such an environment, energy price shocks do not need to be catastrophic to matter. They matter because leverage magnifies sensitivity. In highly leveraged systems, small shocks compound faster than policymakers can respond. The margin for error shrinks. Energy-driven geopolitical risk typically triggers defensive positioning. Gold often receives inflows. The US dollar strengthens as a liquidity anchor. Emerging market currencies can come under pressure, particularly energy importers. Why? Because investors reprice risk and seek stability. Oil becomes a global confidence barometer. When it moves sharply, risk appetite contracts. Capital reallocates. Trade balances shift. Financial conditions tighten. Producers can attempt stabilization. OPEC Plus may increase output incrementally. Strategic reserves can be drawn down. But these measures are linear. Geopolitical risk premiums are nonlinear. Markets move faster than physical supply adjustments. Energy infrastructure cannot be scaled overnight. This lag generates volatility. Volatility feeds into bond yields. Bond yields feed into fiscal constraints. And fiscal constraints influence long-term geopolitical positioning. The oil shocks of the 1970s preceded prolonged inflation and structural policy shifts. Today's leverage levels are significantly higher. The sensitivity is greater. Energy shocks historically precede broader tightening cycles. Not always immediately, but structurally. When oil rises sharply, inflation expectations adjust upward. Policy space narrows. Debt servicing pressure increases. Growth forecasts are revised downward. In a leveraged global system, volatility in energy pricing alters every risk calculation that follows. This is why the moment is consequential. Not because oil may reach $100, but because volatility inside a leveraged architecture forces recalibration. Oil is not merely a commodity, it is a macro transmission mechanism. It sits at the intersection of geopolitics, inflation, monetary policy, and debt sustainability. If supply risk persists, the implications will not remain confined to energy markets. They will propagate. This may not be the final domino, but it is almost certainly the first. Because in a leveraged world, shocks rarely stay contained. They reshape the architecture. And architecture determines power. The first domino rarely falls alone.